Well, rising unemployment and less consumer spending mean the decline in corporate earnings is bound to continue. According to analyst estimates compiled by Bloomberg and Standard & Poor's, companies in the S&P 500 will report a 21% drop in profit for the third quarter, which started last week. At least that's better than the 34% drop they expect for the second quarter, which just ended. Our reporting found that consumers in the United States are reluctant to open their wallets. They're still concerned about their jobs after unemployment reached a 26-year high last month. Whatever improvement we do see in earnings may be because of cost cutting, and investors say that is just unsustainable. For more on what a tough earnings season could mean for the stumbling stock markets, we're joined by Sam Stovall. He is chief market strategist for Standard & Poor's, and he joins us from his offices here in Manhattan. And Sam, thanks so much for being with us. I was looking at your predictions compared to our Bloomberg survey, and you're just slightly more optimistic in terms of the second quarter and the third quarter. You still predict that earnings will fall. So what can we expect, though, in terms of the stock markets?
Well, I think the stock market right now is sort of retrenching heading into the second quarter earnings report, because I think, like in the beginning of the first quarter earnings season, investors are worried that, as you said before, most of the improvement in the first quarter was the result of cost cutting, not as a result of top line growth. And I think there are an awful lot of headwinds that could probably cause second quarter earnings to also not see a lot of top line growth.
Well, how long is this cost cutting, though? How long is it sustainable for? How many quarters are we talking about?
Well, our expectation is that even though we lost about 10 cents per share on the S&P 500 in the fourth quarter of last year, which was the first time ever that we lost money both on an operating and on a GAAP basis, that we're probably going to see a slow increase in earnings over the next several quarters. Again, if it were a company, we would be earning about $10 a share in the first quarter, about 14 this quarter, and then 15 and 16. So slight increases over each of the next coming quarters.
Right, slight increases, and then finally a positive earnings season in the fourth quarter. I mean, can you tell us, though, what we might be expecting in the last 3 months of this year?
Price-wise for the economy, we're likely to see us be about halfway, 1/2 of 1% decline in the third quarter, and then a 1% gain in the fourth quarter. In terms of earnings, likely to see about $15 a share in the fourth quarter, $16 a share in the fourth quarter. In terms of the S&P 500, our belief is we're likely to see a retrenchment in prices, probably go down to about 825 on the S&P 500, but then probably stage an end-of-year rally as investors look ahead 12 months to a recovering economy and rebounding earnings.
Well, is that going to be when we get the true earnings picture? Because what I was trying to get at before, Sam, is that, you know, we're seeing earnings get better because partly due to the cost cutting that companies are doing. But when are we going to start seeing top line growth, and that's going to fundamentally bolster earnings or support earnings? And when do we get that fundamental picture?
Well, I think that the forecast for revenues is still likely to be fairly slow. A lot of companies are going to be engaging in cost cutting, and I think that the reason why the economy is likely to be rebounding in the fourth quarter is really because you have to replace things that have gone out, not necessarily because we're seeing an improvement in the employment picture, et cetera. So I think it's still going to be an awful lot of cost cutting that will be driving a majority of the earnings improvements.
Okay. Well, then let's break it down, Sam. I mean, where do you think you're going to see the most improvement in earnings, and where could you see the worst?
Well, there are likely to be about only 3 of the 10 sectors in the S&P 500 posting year-over-year increases. Your traditional ones being healthcare and consumer staples, but surprisingly, consumer discretionary is likely to see an improvement. But that's more of a statistical anomaly since S&P removed General Motors from the S&P 500 index. Basically, only staples and healthcare are likely to see a majority of the industries within their sectors post increases, and the greatest increases are likely to occur with brewers, with soft drinks, with the independent power producers and utilities, as well as IT consulting and technology, areas that basically where the demand is fairly static.
But how does joblessness, how does that play into all of that then in that scenario?
Well, I think joblessness is one of the concerns that we have for 2010. While we do believe that the economy will grow about 1.3% next year, it will be a jobless recovery, mainly because we expect unemployment to remain above 10% till the third quarter of 2011.
Okay, Sam, good to talk with you on this Monday morning. Sam Stovall, Chief Investment Strategist at Standard & Poor's, giving his take on the earnings season to come.